Hello there. In this session, we're going to look at how to account for cost of goods sold and inventory. We're going to start by looking at the nature of inventory and cost of goods sold from the perspective of financial statements. Okay. Then we're going to look at the various inventory costing methods such as specific identification, FIFO, LIFO, weighted average. And then we're going to look at the effect on different financial statements when we choose these various inventory costing methods. Finally, we are going to look at how to update your inventory valuation at the end of each time period based on lower of cost or market, or it's also known as the LCM method. First, let's get started with understanding the nature of inventory and cost of goods sold. Inventory is considered a current asset because you typically expect to sell your inventory within a period of 12 months. Okay? It is also typically valued at the cost of acquisition or the cost of purchase, right? But we'll see at the end of this session where we learn about the LCM method that at the end of each time period, we'll have to check for this valuation of inventory to see that if it can still hold. We've already seen how to do journal entries for when goods are sold. Okay, depending on whether cash has been collected or not, you would debit your accounts receivable or cash account, okay, and you would credit your revenue account. In addition to that, you would also credit your inventory account because the goods leave the inventory and they are being sold to the customer, right? So you would credit your inventory account and you would debit your cost of goods sold account, which is an expense. If you typically consider a production company, okay, they would hold inventory in the form of either raw materials or work in progress or even finished goods, right? On the other hand, if you consider a merchandising company which just buys and sells products, okay, they would hold these merchandise goods as part of their inventory. All these goods stay in the inventory until they are being sold to the customer. Now let's look at the math behind calculating your inventory or cost of goods sold for each time period. Okay, for a particular time period, let's say you begin with a certain amount of inventory, and that's classified as beginning inventory. During that time period, if you're a production company, you might produce a certain amount of goods, or if you're a merchandising company, you might purchase a certain amount of goods. Okay. Together with the beginning inventory, what you have is the goods available for sale. And out of the goods available for sale, whatever is sold during that period is classified as cost of goods sold under the income statement. And whatever is not sold during that period still remains as part of your inventory and can be called as your ending inventory. So at the end of this particular time period, this is shown as inventory under assets in your balance sheet. If you'd like to formulate this relationship mathematically, okay, you can say beginning inventory plus either purchases or production, okay, minus your cost of goods sold. Okay, once you deduct that, whatever is left is your ending inventory. Let's look at the different inventory costing methods that are commonly used. Okay, the first method is known as specific identification method. The second one is the first in, first out method, or it's commonly known as FIFO. The third one, which is the last in, first out method, is also known as LIFO. And finally, the average costing method or the weighted average costing method is also known as AVCO. Let's look at the specific identification method first. In this method, you're able to identify specifically which unit of your inventory has been sold. For example, let's say you are in the business of buying and selling real estate. Let's say you acquired 3 units to be sold later, one for $50,000, the second one for $70,000, and the third one for $30,000. Let's say you sold the second unit, okay, which is valued at $70,000, okay, then you would credit your inventory by $70,000 and you would debit your cost of goods sold by $70,000. You don't have to do any complex math in this case because you are able to identify specifically which house has been sold and that value is deducted from your inventory. Let's look at a visual comparison between FIFO, which is first in, first out, and LIFO, which is last in, first out. FIFO works similar to a queue. Okay, whoever entered the queue first is the first one who is being served. So from a production perspective, the unit that was produced first will be the unit that is being sold first. Okay, even if the units are not produced and sold in that particular order, okay, for the purpose of inventory valuation, we are going to assume that it's always first in, first out. Okay, so under FIFO valuation, we are going to assume that the products that were produced first were always the ones that were sold first. Moving on to LIFO valuation, okay, LIFO mirrors something like a stack. A stack can be used to visually represent LIFO valuation. Okay, it's something like a stack of plates. Okay. Let's say a company produces a certain number of products and stacks them. Okay, the last one that was in would be the first one that is being out and being sold. Okay, so in LIFO valuation, we are always going to consider that the last product that was produced will be the first one that is being sold. Let's better understand FIFO and LIFO and also the average costing method using an exercise. Okay, Joe had a beginning inventory as of the 1st of January of 50 bottles valued at $10 each. Okay, during the year, he made the following purchases. On the 20th of January, 20 bottles at $11 each were purchased. Okay, on the 15th of March, 45 bottles at $12 each were purchased. Okay, and on the 2nd of July, 60 bottles at $12.5 were purchased. And finally, on the 14th of November, 30 bottles at $13 each were purchased. You can see that with time, the cost of each bottle has been going up, right? Okay. Finally, he sold 125 bottles over the course of the year. Okay. Calculate the cost of goods sold and the valuation of ending inventory using the FIFO, LIFO and the average costing methods. Let's tabulate this information first. So the beginning inventory, he had 50 bottles at the beginning of the year, okay, and each one was valued at $10 each, okay. And then he made a series of purchases during the year. Overall, he had 205 bottles that were available for sale during the course of the year. Let's look at how to calculate the ending inventory and cost of goods sold using the FIFO method, okay. In the FIFO method, we are going to assume first in, first out, okay. So whatever units were available first are going to be considered as the first ones that are being sold. Okay. What was available first was the beginning inventory of 50 units which was available at the beginning of the year. So how many bottles did he sell during the year? Was 125 bottles. So these 50 bottles will be considered to be the first bottles to be sold in the FIFO valuation process. Okay. So these 50 bottles will be sold. So that's 50 out of 125 bottles taken care of. We still have to account for 75 bottles that were sold. Okay. So then we move on to the first set of purchases, which was done on the 20th of January. Okay. That set had 20 bottles. Okay. Because we still have to account for 75 bottles. Okay. We're going to sell all 20 of these bottles. Okay. So units sold from this category is all 20 bottles. So out of the 75 bottles, we've accounted for 20 bottles now. We still have to account for 55 more bottles. Okay. So then we move on to the next set of purchases. Okay. Which was done on the 15th of March. Okay. That set had 45 bottles. Okay. So again, we're going to account for all 45 bottles and consider them as sold. Okay. So out of the remaining 55, we've accounted for 45 bottles now. Okay. So then we move on to the next set of purchases. This set had 60 bottles. Because we still have to account for only 10 bottles, okay, we are only going to consider a part of this set of purchases as being sold, okay. We're going to consider 10 units out of the 60 as being sold, okay. So to calculate the cost of goods sold, okay, 50 times 10, which is $500, okay, 20 times 11, which is $220, 45 times 12, which is $540, and 10 units, okay, out of the 60 units, okay, 10 times 12.5, which was $125. Together, when you add them up, this gives you the cost of goods sold under first in, first out method. I've also highlighted here how to visualize this FIFO. Okay, you start from the top and you go on until you sell your first 125 bottles. Okay, so everything that is left unsold remains as part of your inventory. Okay, so that becomes your ending inventory or simply inventory at the end of the period. Okay, so the remaining 50 bottles out of this set of 60 and all 30 bottles which were purchased on the 14th of November will remain as part of your inventory. Okay, so the ending inventory can be calculated by 50 times 12.5 plus 30 times 13. Another way to calculate your ending inventory is to simply subtract your cost of goods sold from your goods available for sale. Okay, that has been shown here. Okay, $2,400 is your goods available for sale minus your cost of goods sold should give your ending inventory valuation. Okay, under LIFO methodology, we do the same, but we start from the last purchase. So let's look at the calculations using LIFO methodology. Okay, because 125 units were sold, we start from the last set of purchases now, okay, which was done on the 14th of November. Okay, so that's 30 bottles. Okay, 30 times 13 is $390. Okay, so that's 30 out of 125 accounted for. Okay, then we move to the next batch, which is 60 bottles. Okay, so 60 times 12.5 is $750. So now totally we've accounted for 90 bottles out of 125 bottles. Okay, we still have to account for 35 more bottles. So then we move on to the next earlier purchase made, which was on the 15th of March, okay, which was a set of 45 bottles. Okay, we're going to consider only 35 out of those bottles to be sold, okay, because that would give us a total of 125 bottles. Okay, so 35 times 12 gives you $420. Okay, together the cost of goods sold for those 125 units is 1,560. The ending inventory under LIFO is the remaining 10 bottles from this batch plus this 20 bottles and the 50 bottles from the beginning inventory. Okay, so that can be calculated as 10 times 12 plus 20 times 11 plus 50 times 10, or simply you can subtract the cost of goods sold from your goods available for sale. Okay, so your ending inventory valuation would be $840. Next, under the average costing method, first we calculate the unit cost of all the goods that were available for sale during that particular period. So the beginning inventory, which was valued at $10 per unit, and all the purchases which were made during the year for varying costs, okay, you find the average, or to be rather more precise, okay, you find the weighted average for all these costs, okay. So how do you do that? 50 times 10, that's 500, 20 times 11, so that batch of purchases is valued at $220, okay. So you repeat that for all the batches that were being purchased during the year along with the beginning inventory, okay. So totally the goods available for sale is $2,400, and how many units did you have available for sale during that period is 205 units or 205 bottles. So when you divide 2,400 by 205, you get $11.71. That's the average unit cost for all the bottles that were available for sale during that year. Okay. Now we use this $11.71 to value your cost of goods sold and also your ending inventory. Okay. So to calculate the cost of goods sold, you take $11.71 and you multiply it by the number of units that were sold during the year, that is 125. Then to calculate the ending inventory, you can follow the same process as before. Okay, you subtract the cost of goods sold from your goods available for sale, or you can also do 11.71 multiplied by the remaining goods that were not sold and are still part of the inventory. That is 205 minus 125, that's 80 units. Okay, 80 times 11.71 should give you the same answer. Okay, in this example, we considered a scenario where costs were rising with time. Okay, so the beginning inventory was valued at $10 per unit, and with time you can see that the costs are rising. Okay, how does this impact the various financial statements? Okay, here I've just tabulated the results of the previous exercise. Okay, under FIFO, this is the cost of goods sold and this is the value of your ending inventory, and under LIFO and also using the average costing method. So when costs are increasing, we can see that the cost of goods sold under FIFO is lower than the cost of goods sold under LIFO. And for the ending inventory valuation, it's vice versa, right? Okay, the valuation of the inventory under FIFO is higher than the valuation under LIFO. You can also see that when you use the weighted average method, okay, the valuation of your cost of goods sold and inventory is in between what you would obtain when you use the FIFO or LIFO method. Okay, 1463 is in between 1365 and 1560, and 936 is in between 840 and 1035. So when costs are increasing, we can see that the cost of goods sold is higher under the LIFO methodology, because under LIFO we are selling the most recently purchased product first. So when costs are increasing, they would also be the units with the highest cost. Okay, hence the cost of goods sold is higher under LIFO than under FIFO. So if cost of goods sold, which is an expense, is higher under LIFO, it means under LIFO you would end up with a lower pre-tax income in comparison to FIFO. Okay, so if your pre-tax income is lower, it means you pay a lower income tax under LIFO, and you would also end up with a lower net income. Okay, because your pre-tax income was lower, which means you would also end up with your lower net income under LIFO methodology. And looking at the valuation of the ending inventory, we can see that under FIFO, it's greater than under LIFO. Because under FIFO, you're still left with the most recently purchased units in your inventory, which are also the units with the highest costs. So the ending inventory valuation under FIFO would be higher than as compared to the ending inventory you would get using the LIFO methodology. On the other hand, when costs are decreasing, which is very rarely the case, okay, you can reach your conclusions by flipping this table around. Okay, you can see in the other table when costs are decreasing, that cost of goods sold is higher under FIFO methodology, okay, but income taxes, net income, and the ending inventory valuation are all higher under the LIFO methodology. Finally, we're going to look at scenarios like drop in inventory value or damaged goods or stolen goods, okay? And we're going to look at how to recalculate the value of the inventory, okay, based on the valuation of lower or cost of market method, okay, or it's also known as the LCM method. Typically, you measure your inventory at the cost of purchase, right? But at the end of the period, okay, if you realize that the inventory that you hold could be replaced at a lower cost, okay, then that new replacement cost should be considered as the value of your inventory. Doing this agrees with the conservatism principle where you don't overvalue your assets when they can be replaced at a lower cost today. Further, if your goods were damaged or stolen, okay, you need to update your inventory value with the net realizable value of the actual goods. The journal entry you would use to update the inventory value in these scenarios, okay, is you would credit your inventory account by the value that was lost, okay, and you would debit your cost of goods sold account and you would consider them as an expense in your income statement. Let's understand this LCM method using an example, okay. Joe is preparing his annual financial statements. Ending inventory information about his major products are shown as below in the table. Compute his ending inventory valuation using the LCM rule, okay. So Joe has 3 products, product A, B, and C, okay, and you have the quantity on hand for each of those products, okay, and you also provided with the unit cost when acquired, okay, and you also have the replacement cost or the market cost at the end of the year. So for product A, you can see that the replacement cost or the current market value is lower than the cost of acquisition, okay, so you need to update your inventory using the $8 instead of the $10, okay. For product B, the replacement cost is actually higher, so you don't have to do any changes. Okay. For product C again, the replacement cost is lower than the cost of acquisition, so you will have to make the necessary adjustments. Let's see how to calculate this new updated inventory valuation. Okay. So for product A, the 30 units on hand, originally the valuation would have been 30 times 10, 300, but the new valuation should be 30 times 8, which is 240. Okay, so the valuation of the inventory has to be lowered by $60. Okay, so going back to the journal entry, okay, you would debit your cost of goods sold by $60 for product A, okay, and you would credit your inventory by $60. Okay, and then for product B, you don't have to do any changes, okay, because the replacement cost is higher than the acquisition cost. Hence, the value of the inventory for product B would remain at 40 times 12, which is $480. Okay. For product C, again, the replacement cost is lower than the cost of acquisition. So you have to change the ending inventory valuation from 25 times 20, which is 500, to 20 times 21, which is 420. Okay. So the new valuation is lower by $80. Okay. So the journal entry would have been debiting cost of goods sold by $80 and crediting inventory by $80 for product C. So for products A and C, the inventory valuation should be updated, okay? But for product B, you don't have to make any changes. This concludes the session on accounting for cost of goods sold and inventory, okay? In the next session, we're going to look at how to account for long-term assets, okay? Particularly, we're going to look at plant, property, and equipment, and we're going to learn about depreciation, okay? And we're also going to look at how to account for intangible assets. Thank you for watching. Cheers.